Okie dokie. So now we are in day 3, final day for the monthly mentorship. We are going to be speaking about balanced price ranges, and we are going to be looking at a small model for everyone to use. We'll define the rules and we'll define all of the step-by-step things that we should do and follow. Okay. Now, before we start, right, I highly advise everyone to go and take a personality test. Okay, not for fun. It's not for fun. It's like it's important. If you want to do it, you can do it. No, that's fine. Okay, but I recommend you to do it. It's called the Neo AC personality test. You have one that's super long, which is like, which requires 60 minutes of your time, and there's one that takes about half, like 15 minutes to half an hour. The only difference is that one gives you, your information in much more detail, whereas the other one does not, right? So just do it and just check it out and see how it is. And you want to be focusing on your emotional stability, right? So that's the one that you should be focusing on, your emotional stability, and just have a look and see what can be done, and just send your results to me personally. Like, no, like everyone doesn't need to know, whose emotional stability is what, right? So just send it to me, and we can there's something I want to tell each and every one of you if you reach out to me. Okay. So right, so that's what I wanted to say. So now let's start off with the balance price range. Okay. So focusing on what we were doing yesterday we learned about market structure, and we learned about swing highs and swing lows, how the market maker buy model works, and how the market maker sell model works. Everything is basically a fancy name for the starting point of a buy program and a sell program, delineated by a swing low and a swing high. Okay, where the peak low is price jabbing into a PD array. Peak high is when price is jabbing into a PD array, forming a breaker, allowing us to enter somewhere here. Okay, so using the idea of market structure, we know that you have, I'll use a bullish example because that's like the easiest one you can use. For example, we have I like that, then we have something like that. Right? So that's the most simple of them all. Now we have to understand that we have to understand this certain thing. We should understand why is price coming back inside, why is price not coming back inside, right? Now we understand that whenever price makes an expansive move, right? So I think it's better if we have candles to see. So uh, why is price making an expansive move, right? So you see, whenever price makes an expansive move, these candle sizes, okay, it implies only the delivery of one side, right? So in this case, buy side liquidity void to the upside, which is only buy side delivery. And after that, we are essentially seeing, right, this liquidity void balancing out this entire left portion of price action. Okay, so what I mean by this is the right side, right? So we have the right, we have the left. The right side balances the left side. Okay, the right side balances the left side. So if the left side is dropping down hard, then at some point the right side should, fill in this drop. Why is that? Because we understand that with this liquidity void, we are only having sell side delivery, right? So we have SSD, sell side delivery, and there is no buy side delivery, right? Zero buy side delivery, because no one else is prepared to buy at these separate price levels over here, right? So that is why whenever price makes a big move down, for example, this entire drop here, and you see price stopping, and price then starts to reverse. So now what does this mean? This means that over from this line I've drawn from here to now over here, right? This is an imbalance. So what you call a fair value gap. Okay, so now this is an imbalance. Now imbalance to what? This is an imbalance from the buy side, meaning you only had sell side delivery here. We had buy side delivery up until this point, right? And we are yet to see this part being filled up, right? This we are yet to see this part being filled up. So at this current point of time, you only have sell side delivery here, you have basically sell side delivery, but you have zero buy side delivery. Okay, you have zero buy side delivery. You have sell side delivery here, but zero buy side delivery to the upside, which is why you want to see price come up, fill the gap, consolidate, and then drop. Okay, so this is something that happens every day, sort of like a market cycle. Okay, so liquidity voids are very important in understanding what do you call balanced price ranges, right? So basically that's what you need to know in order to understand this concept known as the balanced price range. Okay, and so when we look at this now we understand that this left side here has been balanced by the right side, correct? Now when we look at this from a more fractal standpoint, you can see that this upside move here, this entire thing from here to here is what? Your fair value gap. So now, this is your sell side delivery, this is your buy side delivery, and then you have more sell side delivery here, right? You have more sell side delivery over here. And now, when price goes up, we want to see this part being balanced. Why? Because this is only buy side here. There is no sell side over here, right? There is no sell side over here. So we got sell side here, which caps this over here. So this area over here is lacking from sell side delivery. And so what do you get? You get sell side delivery happening right here, and you see exactly that it closes out here, right? So it closes this entire thing out, and price just reacts. Okay, price just reacts. Now what we need to understand, right? It's not always about order blocks, rejection blocks, breaker blocks, mitigation blocks, blah blah blah. Not all about that, right? Market moves, market moves to fill up volume imbalances and fair value gaps, and of course liquidity voids. This is why the market moves. Okay, why the market moves, and it moves with these characteristics, right? This one, of course, it moves is the expansive state. This one is price driving into this area to close the imbalance up, and this one price just driving into the area to sort out any other imbalances inside the liquidity void. So we know all that right now, right? And then we understand that once these guys have been filled up, it goes for external raise liquidity, highs, lows, right? That's exactly what happens. So I'll show you an example as we move on, right? On Euro USD. So all this, right? So this is the cycle that happens every single day, every single week. Okay. So when we think about this fact that okay, left side balances right side balances left side, so meaning the left side has to be balanced. We use this in the context of a liquidity void. Okay, a liquidity void. Now you see these entries over here, meaning this gap fill over here, and all that's fine, right? That's fine. But now when we think about it, when we think about why might price come back down lower, right? We should think about that. Why will it come back down lower? That's because this left side, right? So now if I just draw this out, we have this, right? So this is your fair value gap. Is it filled? Yes. But now what do we have? We have this part that has not been balanced, right? This part that has not been balanced. So at what point will price come back there, right? Price will engineer liquidity, so equal highs, multiple highs, all of that, and price will come back down and then slowly, steadily make a move up. So you see now from this rejection block, price reacted exactly there and went higher. Why is that? Now we understand all this, right? Now this wick here, right? This wick over here is essentially something like that. Okay, something like that. Sell side delivery, buy side delivery. So then what happens? This part here is balanced. Why is it balanced? This sell side over here has been met with buy side. So the left side has been balanced by right side. So it's balanced. Okay, and price goes higher. Okay, so that's why it didn't go lower than this point here, right? It did not go lower than this. So since this part is balanced, right, and this part is balanced, what's left? This part. How will it be balanced? Price move down. Okay, now remember everything I'm saying now, right? And between the day before yesterday and today, everything has some bearing in the future stuff that you're going to be learning, right? Now you see, you have different moves here. You have move number 1, you have move number 2, you have move number 3, and you have move number 4. I hope you guys can see where I'm coming from, okay, or where I'm getting at, right? You have all of these, right? So it's vital, very important that you understand this. Okay, balanced price range is not just for entries, but for also providing you a story, context, why you should go there, why you should not go there. Okay, meaning you saw that this part has been balanced. So when price comes here and it reacts, what is it going to be? Is it a fake move? Yeah, it's a fake move. Okay, why is it a fake move? Because we still have this part. Sorry, we still have this part yet to be filled up by the right side. Okay, so this is a balanced price range. So you can take trades from a balanced price range, like yesterday, how I took it over here. Or, I'm sorry, not over there, my bad. This is the, oh yeah, actually it is over here, okay. 15-minute time frame, yeah. So I took it over here, price went up, and then it finished what it had to do, and it came back down, filled up the gap. So was there a trade over here? Yes. Yeah, I remember yesterday how I took that loss over here as it dropped down, that's the one. So that came down to come down here, right? So it came down here, and then it went back up. Why? Because fair value gap. What high did it take out? What high did it take out? This one, right? It took out this one, and then price comes back down again. You see now, it's like what ICT says, right? He says that in the current charter guys, he's introducing an algorithmic theory to them, right? So this algorithmic theory, right? I figured it out, but not completely, unfortunately. Is that there's a step-by-step sort of a thing that happens. Okay, there's some step-by-step sort of function that happens. Step-by-step is price fills up a gap, price goes and takes out a high, and then once that high is taken out, we need to ask ourselves, why does it have to go higher? Why does it have to go lower? That's what we need to ask ourselves. Why will price go if over here, right? Stay with me. If over here, right, you took out the high, and then once you're over here, you have to ask yourself, okay, now price took out the high. Do we have any reason to go higher? For the people who don't know balance price ranges and all of that, about liquidity and all of that, they'll be like, okay, yeah, it broke market structure, you know, if Fibonacci, supply, demand, whatever, I'll buy you over here and watch it go higher. But that's not the case. The step-by-step approach is, once this happens, you're gonna ask yourself, okay, fair value gap has been filled, right? Fair value gap has been filled. We have some form of a swing low over here, okay? And at the same time, we have an imbalance right over here. So now what? We have that imbalance right here. So you're going to be like, okay, so before price has to make a move in a certain direction, it has to fill the imbalance, right? And so as a result, remember the swing high formation we spoke about. Here's your 1, here's your 2, here's your 3. Okay, or you can call this also your 3, 1, it doesn't matter. Okay, so you see price comes down, breaks market structure, returns back to what? Clean bearish order block, and there's a rejection block also used up right over here, right over here. So either way, you could have entered it any way you wanted, because we understand that once it takes, now you see over here we got the reaction because it's very clean, right? So obviously that reaction is going to happen. But remember, I told you, once order flow is in a certain direction, the reactions are going to be very temporary. So here's a temporary reaction into this, price comes down. Okay, price takes this low out. Now it takes this low out, but we still have this low intact. Okay, we still have this low intact. So in terms of this low, right, what do we have? We have rejection block, right? So a cause for it to go higher. Take this out and react from here. Now you see, we can't now questions might come asking, okay, but then shouldn't we go high over here? Because the internal to external, we have to go take out this range is high. No. Again, also see, again I said algorithmic, step by step. Why will it move? Why will it move? from here, right? In order to complete the range, we need to balance the range first. Okay, in order to complete the range, we need to balance the range first. So the balancing has to happen somewhere here. And like I told you guys, liquidity void, volume imbalance, fair value gap. So over here will be a liquidity void, this entire thing. So this part has been balanced, but this part has not been balanced. Price comes down, balances it, reacts from last buy side delivery on the very, very low time frame. Why is it the last buy side delivery? Because like I said, we have this, and what happens? Price comes back here. There you go. And this is exactly what's happening right now. Okay, that's exactly what's happening right now, right? So the context, the story is very important, and this story is obviously liquidity, right? Liquidity, and liquidity is provided in below lows, above highs, and of course, whenever there's a lack of liquidity, what will price do? It will provide liquidity inside this region. So in providing this liquidity, what happens? It engineers more liquidity, and price goes higher, 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 only to come back down at a later point and take this part out. Okay, there's a lot over here, but is everyone with me? Just give me a quick yes or no. And again, while I'm speaking, if you have any questions, just ask me so I can look at it. So far Salim is with me. What about the rest? Okay, all right. Okay, right? So we have all of that. Now let's have a look at something else, right? You can see that from here, right? This is left side, right side. So left side balanced by right side. Okay, done. That's balanced, right? Then we still have this left side and this right side. So from here, balanced, right? Everything is balanced. Now with regard to this range here, okay, everything has been balanced now. This part, okay. Now if you look at it closely, you can see that up, down, balanced, right? Then what? Up, temporary move down, balanced. Up, down, balanced. Why is it balanced? Now why is it balanced? Because this wick again, it's something like this. So this is bearish liquidity void. It has to be balanced by the right side, right? So here it is, balanced from this bullish part. Okay, so balanced. Then let's have a look at this one. This is again same scenario. Wick means big downside delivery, and what's the imbalance part? After this wick has been made, the imbalance part is this, right? The bearish delivery over here. So what happens? Liquidity void. Right side closes this up. Done. And now you see, once it closes it up, does it go anywhere below it? No, right? It goes higher. That was my entry point. Okay, so I'm just trying to see if it will go higher. So now here's where we're at. We are here. We are seeing upside, downside, done. Upside, downside, and now the imbalance is where? Here, right? So unless of course this is going to be a problem, we should see price going higher. Okay, so let me just draw a rectangle over there, so if it happens, you can see it. Okay, here, let's call that sell side imbalance. Sorry, buy side imbalance, because there's no buy over there. Buy side over there. Buy side imbalance. Okay, so let's see how it goes. So in watching that, now we know about all of this, right? We know about all of this. Now your job right now, this is very important, right? Now this is the storyline that you need to practice for the next 2 weeks before we start off everything else that we need to do. Okay, this understanding market structure, and of course you need to know overall order flow also to get trades in the correct direction, right? That's a given. That's a given, right? Remember I said everything is based on order flow, and the rest is just to help us enter and exit. uh, okay, then when we look at entry techniques, entry techniques would mean the based on the different types, right? Sorry, based on the type of the range and the market structure formed. You have this, like I showed yesterday. Then you have that, right? Oops. Okay, let's make it go down a bit lower. Up. Okay, so you had that. Now, there's something that you can understand or you can infer or refer or whatever from this. Okay, when you see a move like this coming back deeper inside, correct, it's because it closed back inside, right? But then you will see sometimes that this move back down on a higher time frame is going to be okay, on a higher time frame is going to be an imbalance. Like I just showed you why this part came down over here, it's going to be something like that. So you have to always look at your higher time frame and see, okay, is this a high time frame imbalance? Yes. When price comes down over here, then where will it react inside of it? Then that is up to you to refine and do all that on the lower time frames. Okay, so that's basically it on the balance price ranges. Then we understand that when we have a clean break like this, right? Clean break like this, not to worry. If your order flow is correct, price will come back and it will bounce exactly over here, exactly on that spot, right? And it will go higher. Okay, then you have something like this over here, like I just spoke about. If there's an imbalance, it will come back inside, close the imbalance. If there's no imbalance, it will just come back inside to a part where there is an imbalance, plus an order block or whatever, and it will just go from there. Okay, so now you know that the reason for a closure inside of the range is because, and of course a return back into the range is because of something like that. So now let's have a look at these inside the range ones. Let's first look at this. Now this is the overall one. So overall one, when you know the bigger picture, you can take trades up and down, up and down. But if you are closing off your mind, right, to the entire story, and if you just look at something like this, okay, then it's like, okay, I'm seeing this, oh no, it dropped, I'm gonna sell, right? So that's what happens when you don't look at the bigger picture. Okay, so by having something like this, by keeping your charts like this, maybe something like this, right? And by understanding that this is an imbalance, by understanding that this what is over here is a swing low forming, institutional swing low. uh, Potentially we can see the other part forming here in terms of low, this one over here. Although this is not ideal, the ideal one would be this, because we want it to be like that, right? So this is not ideal, but it can happen as well, especially when you have an imbalance like that. Okay, so when you have an imbalance like that, it's very important to go back to the lower time frame and see where can I refine it, how will it react, and all of that. Or alternatively, you can wait for it to come to that spot, react, break in market structure, and enter somewhere here. Same thing. Yeah, same thing. So let's look at this now a bit more closely. You have breaking market structure, price goes up. Why? Now the thing is why, right? So over here, this wick over here and this wick over here, you have what? Imbalance. Well, you have imbalance. Sell side right here. You have imbalance entirely over here, and which has been filled up anyway. So you see, it fills up. Let's just draw it out here. This imbalance fills up. Done. And what does price do? It attempts to fill up this and it fails. Okay, it fails. And obviously we know why. We know that we got the break in market structure, and the context is we have this imbalance yet to go, right? If price is indeed gonna be coming back up, right? It will fill this part up at a later point in time, right? So you can shift your perspective like that also. If you don't see something that you want to see, you immediately take a step back. Okay, I see an imbalance over there. It will first come back down there, then it will go back up. That's how you should think, right? Be flexible. Okay, so we have that. So now let's keep this also over here. Now you see it filled it up a bit, right? So now when it fills up a bit like this, we can now close it a bit here, right there. Now this is your next imbalance alongside this imbalance. Okay, alongside this imbalance. So left side, right side. Then you have left side, right side, yet to be completed. Okay. Then let's look at another one. You have here down liquidity void. So then what? You have balanced price ranges here, here, balanced. As a result, price dropped. And then once it took out the low, what does it realize? It realizes that, oh shit, we still have more balancing to do. Where's the other balancing required? Here, here, right? Here and here. And then if you see that okay, the balancing is not complete, then that is still a cause to go higher. See what happened? Complete, right? Complete. Okay, so that's basically it, right? So the balancing is the most important part. When price leaves with a liquidity void or whatever, okay, and when it takes out external range, right? When it takes out external range and when it tries to seek internal range, okay, it's gonna go for rebalancing. That's basically why the retracements happen. The retracements always happen because it has to rebalance it. Okay, provide liquidity, all that. Okay. Look, okay, it's not a game where you say okay, retail stops there stops here, this is where retail psychology says they should sell, they should buy. That's all bullshit. Okay, sure, they buy and sell over there, but someone tell me, okay, someone tell me, let's say I am working, let's say I am I have, obviously I'm going to start the hedge fund soon, right? Now let's say I have like a millions and millions of dollars under management. Okay, and if I see Bitcoin coming over here and I think to myself, uh, okay, so people are going to be selling over there, so I'm going to buy, right? uh, does it really make a big difference? I'm buying to make money, right? I'm buying because I understand that there is literally zero buy side delivery over there, so I'm buying to fill up that gap, right? So someone answer me, right? Will I really give a shit whether retail is going to sell over there? Someone tell me, will I really give a shit on whether people are going to be selling over there? No, right? Is the central bank going to give a shit that okay, so if they're going to be selling over here, their retail stops are going to be there? Are they going to really give a shit about that? No, right? They have enough money to move the market. Retail stops doesn't really matter. Okay, it doesn't really matter. It just fuels intraday volatility. Okay, it fuels intraday volatility. Simple as that, right? It's not a game. It's just stops. Stops are there for liquidity. Liquidity is there for what? Counterparty matching, coupling. Simple as that. Okay. Can you explain what buy side delivery and sell side delivery is? Buy side delivery is the left side. So basically, buy side delivery are the bullish candles. This move up, and sell side delivery is the down move. So buy side delivery is the up move. Sell side delivery is the down move. That's all. And a place where there is no delivery of the opposite counterparty is the imbalance. Okay, so that what I was saying was uh, the big smart money, big money, whatever you want to call them, right? They really don't care where retail stops are. They all they know is, and all they care about is, okay, we have stops over there. That's our liquidity. We are going to go for it because we want to move price. How are we going to move price? We are going to move price by triggering those orders and then getting counterparty from them and then reversing price. Simple as that, right? They don't look at what the mass is going to be doing. Okay, so that is basically it about the balance price range. Yeah, I covered it. No worries, no worries, no worries. So that's basically it about the balanced price range ideas. Okay, always think about that when you're looking at the chart, and especially when you look at the 15-minute, 5-minute, all of that. All right, let's look at this. You have balanced price range, and now you see price went up like this. Okay, went up like this, close back in the range. Okay, that's number one, close back in the range. So we should expect price to be going lower, right? Then you're going to be asking yourself, okay, uh, where are the imbalances? Where are the imbalances? We have the imbalance here, here, right? And you can refine it on the lower time frame, right? Here, here. And you see what happened over here, right? You see price down, up. It wicks because I believe there was some news right on Thursday, so that's normal. And price ends up coming back down here. So once it comes back down here, okay, once this is completely balanced, every small portion of this range, after everything has been completely balanced, all right, what's left? Okay, now what you should be asking is what is left inside this range? What can be seen? You have imbalance here, right? You have imbalance over there, which is then what? Cause to trade, cause to take another trade. Where? Down. Now you see, you take the trade down. Now you see where is the imbalance? When you take the trade back down, there is the imbalance from here, right? From here to here. It's fine if it wicks, but it's from here to here. So right here, right? Imbalance. So goes up to cover this, comes down to cover this. Then inside this part, right? Let's zoom in because I can't see it properly. I think I need to take this out. Right over here, right? You see price goes up, right? Goes up, comes down. Then that's done. We just covered it. Then you see price over here. What's the imbalance, right? That's the question. What's the imbalance? You see upside delivery, downside delivery, upside delivery, downside delivery. And so what's the imbalance? There is no delivery here, right? For now. So here's your imbalance, which is why price reacts and comes lower. Then over here, why is price coming back down? That is of course some lower time frame thing, right? Because it stopped over here means there's some lower time frame thing to it. Now you see why is that? Because sell side delivery, buy side delivery, and then in this liquidity void here, right? In this liquidity void over here, where was the price imbalance? Here, right? From here to here, from here and above, from here and above, and price comes, fills it up, and goes up. Okay, goes up. So it will be good if everyone on a daily basis look at the imbalances, and when you see the imbalances, especially on the 15-minute time frame, you can pinpoint exactly where price is going to go, right? You can pinpoint exactly where price is going to go, and this is basically how balanced price ranges work. Okay, this is basically how balanced price ranges work. And again, you see price goes up and then it stops exactly where it was imbalanced when it had been balanced. Okay, then here, right over here, you have downside, and now what's the imbalance happening? Imbalance is from here, right here to here, here to here, here to here. So then what? Here to here. And then once price balances this small part over here, where can you refine it to? You can refine it to here, right? Refine it here. And that's your imbalance or your fair value gap. Price goes there, fills it up completely, and then what happens? Comes back down. So it's a constant cycle of the same thing happening over and over and over again. If you know what you're doing, you can definitely trade every single move that happens. Okay, so essentially at the end of everything, you are going to be mini rhymes, or you be mini IC. Okay, we can't be mini ICTs because we don't know everything he knows. But yeah, mini rhymes. Okay, so let's see how everyone does. Let's see how it works out, right? Is everyone with me? This is all study material. Intense studying required, right? Especially this part, day three stuff. Mini rhymes. Rhyme is the guy who claims he knows Enigma, ICT's own personal algorithm, and he claims he knows it. So, and he can trade every swing in the market, right? And they charge $2,500 for that. Just to explain what I just explained to you guys, but of course I have more coming up. So so that's why it's just imbalances, man. That's all. Imbalances and liquidity. That's all. I don't think I see the imbalances. Yeah, because it's all in the wick. Most of them are in the wick. Like, don't think of it as looking at it like a fair value gap, right? Just think of the delivery. That's the question. Yeah, I know. As you can ask. Mini question. How important is the time of day with regards to price delivery? Very important. London session, New York session, very, very, very important. Anything between that is okay for letting your trade run or trying to catch a reversal if there is one. But yeah, if you try to trade outside of the session, right, highly unlikely that highly unlikely that imbalances will be filled in that quickly the way you expect it to fill, because we don't have smart money chasing liquidity, right? So yeah, we basically, if you don't have smart money chasing liquidity, then it will take some time for certain things to happen. Like for example, Bitcoin. See how long it's taking. You get me? Yeah. Okay. And so that's all I have on balanced price ranges, because it's just theory and just how it looks like, right? You don't see the imbalances, I get it, but this is something that you will have to go back, in the video, and you have to internalize it yourself. Okay, I show the examples. You see why I showed you the examples, right? Go to the lower time frame. Now, if you go to 5 minute chart, you see I showed you the 15 minutes. On the 5 minute, can you see the imbalance now? Exactly. Yeah. So this entire thing. Okay, and see price comes there, fills it up, does a swing low formation and goes up. Okay, have you tried imbalance and delivery in 1 minute time frame? That's what I do most of the time, but let's have a look as an example. The same price move here. You can see now if we pinpoint the what do you call uh, the imbalance, right? You can see that we have downside, upside, done. And in this upside delivery, right, we have downside, upside, and you have this small volume imbalance right here. So we draw that out right here. Okay, and then you have uh, downside, upside, but this upside here has no downside, right? So this small gap here. So let's see, and you see exactly where it happened, right? It happened exactly where that small upside had no downside, and that was the rebalancing. And you can now see that the peak formation of the swing low is what? Jabbing into a imbalance or PDRA, and then same thing happens here, where it happens between this I used the wrong tool. Between this one and this one, and so imbalance, now balanced here, and it goes up, right? So that's basically it. And you see, when will it now question is this: when will it close the imbalance, right? When will it close the imbalance? After it breaks market structure. After it breaks market structure, all the imbalance closing happens. Break market structure here, closes the imbalance here, and then of course it goes lower, and then you have break in market structure here. We still have this imbalance over here. It did not quite touch it, meaning that if it reacted, it's going to come back at a later point. So at a later point, what will that later point be? When there's a obvious break in market structure here, and then hint for the next session. Reacts down. Done. Price goes up. After it goes up, what's there? Volume imbalance here. You get a trade. We're going to get a trade to somewhere here. Okay, get a trade somewhere here. Now, after you take that trade, you're going to be looking at, okay, what's the next volume imbalance? Is there any other imbalance in the area, right? Is there any other imbalance in the area? So you have what? You have up. Sorry, you have down, up. But does this upside have any downside? No, right? So here's your imbalance. Here's your fill. Price goes up, and then if you just look at it now, you see that every single thing, break here, price comes down, so you have upside, downside, but this part has no delivery, right? This part has no delivery. Let's see if we get it later on. So it's from here and here, kind of, yeah, here. Let's see if we got that. Yet to get that. So we are yet to get that at a later point in time. Okay. So, and of course, you look at the higher time frame, like for 15 minutes as well. Okay. So here is that example where this is a volume imbalance that price will definitely fill at some point. And that point should happen soon, I believe. Yeah, should happen soon. Then price goes up. Same story. Here it's balance, goes up. Is this balance? No. From here to here, price comes, goes up. Same thing in every single time frame. Everything you see. Okay, so that's basically how you do it. And the most important part is a major structural break. So break here, back down, break here, back down. Then the major structural break is this one because big swing high. Break, and now see when it breaks over here, we need to see, okay, is there anything obvious? Is there anything obvious here? Let's have a look. So over here, we just spoke about this being a later one, but over here, do we have anything obvious? You have this sell side delivery, buy side delivery, and we have a small sell side delivery here, right? So now the question is, we don't have delivery from here to here. And did we get it? Yes, we did. Okay, yes, we did. Then you can see that again, this happened when did this move happen? After it took out a high. So it slowly came down. Okay, then you can see downside, upside. Now you see something like this. Is it balanced? Yes. Why? Big downside, big upside. So essentially, this downside delivery has been matched with this upside delivery, right? Downside has been matched with upside, so balanced. Okay, it's balanced. And then when you have something like this, you have again major structural break. Price comes down, goes up, down, blah blah blah, normal stuff. You have this is your swing high, so you get the major break, right? You get the major break, And now once it breaks, you have to think to yourself, okay, now is it going to continue going up, or is it does it have something else to do before it goes up? So let's have a look. You have volume imbalance, so it needs to come down, fill this volume imbalance. Then you have upside delivery, downside delivery, but no real downside delivery for this part, right? So here you go, you have that. And for this small part over here, so this of course is x-ray stuff that if you are a perfectionist only, you'll be doing all this, but I don't think everyone will be doing this. So I'll just look at the most obvious stuff, right? So that's basically how it, so that's the idea, right? That's the idea that there are people are really paying too much for. So here you go, same thing, swing high, break in market structure, it goes up, and then it has to come down for something. What is that something? You have sell side delivery, buy side delivery, and what's the imbalance that you can find? You have another swing high over here, from here, right? From here to where? Here, here to here, here to here, right? So this downside has been balanced. This upside, right, has only been balanced by this much, right? And the buy side delivery has to be balanced from here to here. Okay. And again, so it came into this buy. Okay, now let's go back to the 15-minute. So again, don't confuse yourself on the 1-minute chart. It's always based on the 15-minute chart. 15-minute chart will show you which part is imbalanced or which part is not. Okay. So you have, now we are starting to fill up this buy side imbalance. Now this is filled, small portion filled up. So we close it up now. All right. So is everyone okay? Can we move on to that model to create for the group? What about the rest? Yeah, so just guys, just say yes or no. I'll soon get me a bottle of water and come. My mouth is dry. Okay. All right. So let's start. Let's start with the model making. Right. Start with the model making. Now, all this time I was speaking about some stuff that is the basis of your model. Um, you are gonna let's write it down. Okay. I'll type it down so it's easier for everyone. Okay. Right. So this is the day trading scalping model. Okay, day trading scalping model, and the pair, right? The pair that we want to focus on will be okay, preferably Euro USD for the tight stops and easy volume and the easy volume that comes with it. Okay, so the time frames that you want to focus on would be M15 as your high time frame, as your HTF, your M5 and M1 entry and imbalance identification. Okay, had that. All right, so time frames, 15-minute as your high time frame, M5 and M1 your low time frame for entry and imbalance identification, and you're going to enter limit orders. All right, and the contingency is you were too late. You're too late to enter the trade, and you would immediately go for the market execution of the immediately go for a market execution, right? That's your entry type. Limit orders, contingencies, you missed it. So you immediately go for market execution as long as price is very close to that entry point that you were looking for. Okay. Then you have to see basis of entry. Number one, questions to ask yourself, right? Make an institutional swing high, low on either the STF or LTF. Either one works. Okay. If price make an institutional swing high, low on either the STF or LTF. Number two, if so, did the peak high, low, peak high or low, jab into a PD array, right? If so, did the peak high, low jab into a PD array? Okay. Then did or was there a break in market structure on any of the lower time frame, right? Was there break in market structure in any of the lower time frames? Is there any volume imbalances to be seen if the break was unclean? Okay, was there a break in market structure on any of the lower time frames? Is there any volume imbalances to be seen if the break was unclean, right? Then finally, if the break was clean, look for reasons for price not to go back deeper into the range. Clean balanced price range. Okay. Then finally, you will say entry one will enter on an imbalance. BPR, clean OB, or rejection block, which is the special case for an imbalance entry, right? Rejection block. There you go. All right, so just go through this and give me like 2 minutes. Yeah, give me 2 minutes and just go through this though, and ask any questions if you want about this. And just you can give me some improvements that I can make. So just think about that, and I'll be back in 2 minutes. Yeah. Okay. Anyone have any questions? And again, this is these different questions that you ask yourself are questions that we are going to be going through again in 2 weeks, right? So better practice now so that it won't be hard when you learn it. PDRA can be on H1, H4, M15, anything. But as long as a peak high low has formed on a PDRA, anything, like you zoom out and you see which one it reacted to, then that'll be the one. Okay, so then let's add the next part, risk management part. We have risk percentage, 1% or less, right? And you have risk minimization routine is cut risk in half after a loss, right? And your stop loss is dependent on you, so depends on you. Ideally, okay, then your take profit. Six pips in case you want to take the temporary, the pullback trades. Uh, okay, so your risk management is 1% or less. Risk minimization routine, cut risk in half after a loss. Stop loss depends on you, ideally 2 to 5 pips. Take profit between 6 to 20 pips. 6 pips in case you want to take the temporary trades. Minimum risk reward 3R, maximum risk reward for a day 10 to 15R. If you get that trade right, and it goes all the way in the direction of order flow. Okay, so any improvements? And of course, time of day. I mean, I didn't tell you guys that, right? Time of day is London Open kill zone and New York Open. Anyone got any questions? Or can I take a screenshot and send this to you guys? Type SC for screenshot, not SC, SS for screenshot. That means you have no issue, and I'll do it now. Okay, what about the rest? All good. Okie dokie. And of course, yeah, be happy with 1 or 2 trades. Don't try to take so many trades. So be happy with 1 or 2. Okay. So I'm gonna take a screenshot. Send it to you guys. We make it a bit more nicer. So let's move to this side. Here, 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 and then take it up. Here. All right. Discord chat. Where do I put it? Do I put it in the intraday model? Yeah, right. Put it in the intraday model. So let me put extra model to be used as a foundation. FSC prime moment. Here you go. Rules are there. You need to apply your own risk management and all of that for your what do you call own psychology and all. Okay, so I'm going to take this out. We don't need this. Let me actually do something like this. Need to practice this. Yes, you need to practice this. The practice required is for identifying imbalances, and just making it click for your own self, right? As long as it clicks, it will be easy. So let it click, and it will all come with time. Okay, so we have a small part here has been balanced. Now we need to balance this. Worst case scenario, it needs to come here. Yeah. So let's see. Guys, anyways, I'm done. Anyone want to ask any questions regarding anything else? Yes. Imbalances, right? So if you are practicing, for example, if you're just doing your own study, send all your screenshots of everything you do on the chat, and we can all help each other out in terms of identifying the imbalances, right? So I'll definitely help you out in identifying the imbalances. So everyone, if you have any issues or if you're not sure, just do it first and send it on the group, and let's figure out what's wrong. Okay. William fractal, I have no clue. I just use it to identify swing high, swing lows. RS fractal by the guy who I think does the opening price of the day and all. Oh wait, it is, but I don't know what it's used for though. Yeah, I just use it for the identification of swing high, swing low because it's more visual, right? So it helps to make your decisions faster in terms of the swing high, swing low. Okay, I'm going to stop recording so you can speak about anything you want after this. So